really interesting part. If I see eyes glazing over, I'm happy to move on quickly. This is the kind of stuff we talk about every day, but I'm very aware that it's not everyone's cup of tea. So what I really want to just take you through is what I call our financial strategy, and in plain English that means how much is everything going to cost and where do we think the money's going to come from. And then talk a little bit about insurance and some of the other stuff that's in the annual plan, the draft annual plan that's out for consultation. So firstly, our financial strategy. And if I break the financial strategy into two areas, the first area is the normal stuff that council does. So all the facilities we provide, keeping the parks and gardens done, the streets maintained. That's our usual operational expenditure. And then the other part is the growth and the aspiration expenditure. Excuse me. And that's our capital spend. So for our normal activities, they're the normal services that council provides. We fund them partly by rates, partly by fees and charges. So there's some areas in our organisation where we request fees. So building consents, when you go for a swim in a recreation centre, you pay a fee. Some of that's subsidised by rates, some of it comes from your own pocket. So that's a split between fees and charges and rates. As Bob mentioned, we get quite a lot of income from our holding company, CCHL. CCHL owns the airport, the port, Orion, the Lions company. Those companies run as commercial enterprise, and they make a return and give that to the council. Then last year we introduced the special earthquake charge, and really the special earthquake charge over 5 years was to make up for a lot of the revenue that we had lost very suddenly. So things like the parking buildings in the centre of the city, they return us parking fees. They were all of a sudden taken out of commission, and we had to make up for that revenue. And the last part there, in terms of where the money comes from, is subsidies from government. So that's NZTA subsidies, so largely for maintaining our roads. Then if I go on to the capital program, most of the capital program is paid for by rates, and I'll come back to that soon when I talk about how we're going to fund that massive rebuild cost. But the part of our program that looks forward, if you like, building new facilities or providing infrastructure for the growth of the city, we borrow for that. And the reason we borrow for that is that as existing ratepayers, you shouldn't have to pay for the facilities that are going to be provided in the future. So we borrow for it, and then we rate for the repayment of those in the future, which means that the future ratepayers coming in will fund their share of those costs. The pointy-headed term is intergenerational equity. It means that it's fair for people today and it's fair for people tomorrow. Move on to the additional costs that we've had to face this year. Two lots of these. One is the earthquake response and recovery costs, and secondly is that major community facilities rebuild. So firstly, the big number is the earthquake response and recovery cost of $3.4 billion over 5 years. This is the cost of replacing all our broken infrastructure. So the infrastructure that existed at the time of the earthquake, the pipes, the sewers, the roads. As Tony said, our share of this is $982 million. The total cost is $3.4 billion. So that $3.4 billion comes from four major sources. First is from government subsidies. Government, under its disaster recovery plan, funds 60% if council makes provision to fund our 40%. So there's a large portion there that the government will front up with. There's also significant insurance proceeds of over $800 million that we're expecting to fund this work. Then there's what we've called the deferral of the capital renewal. So if you think of that $982 million, round terms, $1 billion, We want to be able to repay that in a ring-fence way, so we're not burdening ratepayers down the track. And the way we're looking at doing that is by thinking of this rebuild as bringing forward a lot of the work that we would have done anyway. So if you look at the amount of work that's going around the city, we would have had a lot of that scheduled in a 20, 30, 40-year program to go around, replace sewers, replace water pipes as they become worn out. The earthquake sped that up a lot for us. So in the next 5 years, we're replacing around 25 years worth of infrastructure. So what we've said is that our renewals program, which we would usually spend about 100 million each year replacing that kind of infrastructure, we can reduce that by about 50 million a year. And we can use that 50 million to repay the debt that we have to take on in the very short term to replace it quicker. And we think that'll help us repay those extra costs or that extra debt in the short term over 20 years. And the last one, the increased rates revenue from year 6. The Mayor mentioned this. The 1.76% that we're adding to make up for the revenue shortfalls we've got over the next 5 years. After 5 years, our rates base will be $29 million higher. So our proposal is that we would then use that $29 million to put towards the debt that we have to take on in the short term. And that helps us repay it quicker. So then from year 6 to year 20, those funds are being used to repay that $983 million worth of debt. So it's a little bit complicated, certainly the most complicated budget that I've had to put together in my career. But we think we've got a plan that actually helps Council get back to its strong financial position after that 20-year life. The next major part of the financial strategy is the major community facilities. Tony mentioned a little bit about this. We estimate that the cost of the Council's preferred option that they've come out for consultation with to be $767 million. We're expecting $367 million from insurance. Leaves quite a gap there for Council of about 400. We're asking government for a contribution towards the convention centre because of its impact on the national economic development of $70 million. And we've also got some of those projects that were already planned for in our long-term community council plan. So when you take those projects out, it takes it down to about $192 million that council needs to get some additional borrowing for in the first 4 or 5 years. And that's that 2% metropolitan facilities rates charge. What that does, it's a one-off. That takes the rates up to 7.5% in this annual plan. And it allows us to then repay that $192 million over 30 years. So perhaps, Amanda, can I just jump through 2 slides and then I'll come back to insurance? So this is a chart. When I was sitting out at home this morning brushing up on this, my wife thought it was a very exciting chart. Not. But it is to me because I'm an accountant. So this really just shows you the black line is the long-term borrowings the council had planned to take before the earthquake. So over time, we were... thanks, John. Amanda will do it for me. Yeah. So that one, the council had always planned to take on more debt to build better facilities, and that line left us in a really strong financial position. It was affordable in the long term because as our debt goes up, so does our rating base. The greeny line at the bottom, that's the debt that we need to take on for the major community facilities rebuild. And as you can see, over a 30-year period, the 2% additional rates charge that we're proposing for the 12-13 year repays that. So after 30 years, that debt repays to zero. And the next one up, which is kind of a denim colour, that's the amount of debt we need to take on for the $982 million of earthquake rebuild. And that's the one that we're proposing to repay through deferring up the renewals in the city or diverting that rates income of $50 million a year. And because we've got more of $50 million a year rather than just the 2%, that repays after 20 years. So adding those three lines together, the line at the top shows you that in the short term, council will need to take on some more debt, but in the long term, it returns us to the position that we would have been before the earthquake. As Tony said, that's always been our objective, to get the city back to where it would have been from a financial perspective, with much better and renewed facilities and infrastructure. Okay, so we go back to insurance. Just to give you a little bit more detail on the council's insurance policies. Tony's covered this at a high level, but our insurance cover was covered through the Local Authority Protection Program, which is a program run jointly by a number of local authorities around New Zealand, most of the local authorities in fact. It's based on the advice of professional valuers, so both our infrastructure and our facilities were all valued on a rolling basis by professional valuers. In general, the roads and the underground services are quite difficult to raise insurance for. But this fund was set up specifically for the underground pipes. The roading side is covered by NZTA subsidies, so we're expecting about 83% of the cost of that to be covered by the government through the New Zealand Transport Authority. And our facilities are covered up to a set value. And that valuation was valued as using the building code at the time of the earthquake. And as Tony's mentioned, that building code's moved, which has given us a bit of a gap if the council wants to go to 100% for all its facilities. And of course it doesn't cover making improvements. So I always compare it to, I've had EQC around to my house, they're having a look at it, and there's a few other things that I want to get done, and they've said to me, well, that's not caused by the earthquake. So I have to put my hand in my own pocket to fund those repairs. Similarly, if council decides to make significant improvements to some of its assets or build much bigger ones, council will have to fund that, and insurance will only cover replacing like for like. This next slide just shows the two major parts of our insurance. So firstly, with buildings, as I said, they're insured up to the replacement value on a scheduled valuation. So we've got a valuation schedule of 1,600 buildings, all of which have been valued, and that's the basis on which, when we go out and estimate the cost of repairs, the insurers will only pay up to the value on that schedule. The total valuation is about 1.8. We're expecting to make a claim against that of around just under 600 million, so 588 million. A massive program of work for us to do, going through assessing all these community facilities, making sure we've got the right information to provide to the insurers. The infrastructure, as I said, is covered 60% by the government and 40% by council, and we insured our 40% through the LAP fund. And the LAP fund reinsured itself up to $109 million per event, and we had 2 earthquakes, so we're entitled to somewhere around 200 million for our share of that infrastructure. So the obvious question to ask is, well, why didn't they take more reinsurance? And the answer to that is, when you look back at the assessment they did using all the best advice they had from GNS and from risk management professionals, they had assessed the value of damage in Christchurch for our infrastructure on a 1 in 1,600 year event to be around $44 million. The actual damage is 900 million. So that gives you the difference in those two numbers really illustrates to me the magnitude of the event that we faced, particularly on the 22nd of February. And you can glibly say, oh, it was more than anyone expected, but when you see numbers like that, it really hits at home that it was significantly more and worse than any of the experts who know about this stuff had imagined. So just moving on to some of the details, I'll go through these slides pretty quick so you can get on to the exciting stuff with Mike. the major community facilities, really just coming down to the bottom line there, the new borrowing required for the preferred options that the council has gone out for consultation with is 192 million. The total capital cost is 767 million, and taking off the insurance proceeds and what we would like to get from the government as a contribution towards the convention centre takes you down to 330 million. We already had some of those funds planned in our long-term budget, so that takes you down to the 192 million. And the cost above insurance is due to two main factors. One, bringing the buildings up to 100% of code, which we have to pay for, and secondly is the significant improvements we're planning to a lot of those facilities. So for example, the convention centre, the old convention centre was 7,500 square metres. The proposal that's been consulted on is 21,000 square metres, and that'll provide far bigger conventions. It'll allow bigger hotels to be built and provide a lot more support to the local economy with a large convention centre. Just moving on, one of my favourite slides, another graph, just shows how Christchurch City's rates compares to some of our other metropolitan cities in the country. The thick line at the bottom is Christchurch City Council's rates and our projected rates levels for the next 10 years. The thin black line in the middle is the average of the other metropolitans. And what that graph shows you is that currently we're the lowest in the country, and that's really, I think it's come about because this city has managed its finances really prudently over a lot of years, so we're just really trying to continue that, making sure we're doing this responsibly. And after 10 years it shows that even with the special earthquake charge over 5 years and that one-off levy we're proposing for this year of 2%, we're still around 19% lower than the average metropolitan council in the country. The other material included in the annual plan, we've obviously updated the capital works program, so each year we review our capital works program, our business as usual, and we update it for any changes. Probably the most significant change this year, apart from the massive rebuild and really the second year of that rebuild and fixing the broken infrastructure, is looking forward and seeing how does this council best support the growth in subdivisions around the city. So we're making sure we're providing any infrastructure that's needed for the various other subdivisions that are going on. So we've had to bring forward, in this it shows 31.774 million. We've had to bring forward a lot of capital spend to make sure when those people who are in the red zone properties need to go and buy another section somewhere else in the city, the infrastructure's there and they can build a new house and connect to the sewers and the water pipes and so on. We have deferred a number of other aspirational projects to make that more affordable for us, and obviously added a large amount for the rebuild. So that's that rebuild program, 654 million in the next year, taking our total capital program to 854 million. And it's a lot of money, but when you compare it to what our normal capital program is at around 250 million, you start to realise the scale of what we're dealing with.